This is the only way to beat the market. Only one way. It's just that simple. I'm going to show you how to do it. I don't know why you'd want to strive to beat the market. Let's just say the market average is 10 and you average 10.15. Hey, you're great. Who cares? Just get the market. Get the market returns minus a little bit of fees you pay for index funds, and you're going to be just fine. But if you're trying to beat the market, this is the only way it can be done. Talking to a guy today, not today, on Saturday. On Saturday, I was talking to a guy, a good guy, and he has a portfolio in this fund right here, which AB Concentrated Growth Fund Advisor Class. So we'll check into this. But this guy's no slouch, let's put it that way. So he knows what he's doing. But I just, he had a margin on this account. I said, man, if I were you, I'd sell the whole doggone thing, pay the capital gains, and pay off that margin, and just put the money on the side and use that to start your business. That's what I would do. Anyway, so it's all good, but it's interesting because he's done well in this fund, very, very well. And I said, yeah, I get it, because check this out. We're going to go to 10 years, and so you can see the blue is his fund right here. 10,000 invested in this fund right here is worth 47,000 now. 10,000 invested in the S&P 500 is worth 40,000, and 10,000 invested in large growth is worth 41,000. So we smoked the S&P 500 and the large growth index. And if we look at the large growth index, we look at the portfolio style box, it's all large growth. Now, how did it do so well against the S&P 500? Well, the answer is, look at this. So we're up 19.79% year to date. Can't freaking shake a stick of that, man. Can't shake a stick of that. I'm not sure how long he's been in this. And by the way, he's getting a dividend as well. So all around, he's made money. But I guess he's not getting a dividend. Oh, that was in 2020 right there. That might be capital gain. All right. But it doesn't way. So it doesn't look like, I would expect it's not paying a dividend. Yeah, I imagine it's not. But anyway, long story short. So I don't know how he got into it. I don't know the first thing about this fund. Only thing, I'm not even sure who I don't even know who AP is. I don't know. I frankly don't care to know. But let's look at this. The reason why this fund, and I want to show you the fees on this guy too. So let's go to fees, fund facts and fees. Oh, right there, I just saw it. 0.78%. So there's expense ratio, 0.78%. So not a horrifically expensive fund at all. So why is this fund doing so well? Because it's not cheap. Large cap growth, done well, I grant you, but it's not cheap. What's going on here? I can show you. Holdings, 19. That's it. 19 holdings is turning over, we'll say, a quarter of those holdings a year. So its holdings are, we'll just say 20, is turning over a quarter of that. That's 5 stocks a year is trading. That's it. So is that high turnover? No, it's low turnover, but it's you're only holding 19 shares, 19 stocks, you're turning over 5 of those a year. That's pretty significant, right? But anyway, that's the only way to do this, man. It's not socially responsible. It's not inverse, all right? And it's not leveraged. All that's good, man. A guy named James Tierney. That James Tierney sounds familiar to me. I'm not sure why. I seem like I'm familiar. Oh, Alliance Bernstein. There you go. Alliance Bernstein. It's not crazily cheap. It's not crazy expensive. It's just your middle of the road fund, but it's concentrated into 19 stocks. All right. Now, what does that mean? That means that this is not a closet index fund. And if you're trying to beat the market, you cannot have closet index funds. You have to have concentrated portfolios. And because what happens is you're taking the risk. You're saying, oh, so let's take a look at the holdings on this. Hold on just a second. We'll go to the holdings. I think it was like Microsoft, a couple others. Let's see what we got here. Microsoft is, so here's our top 10 holdings, which represent 63% of the portfolio. So, I mean, look at this. Microsoft, 9% of the portfolio is of Microsoft, not 8% is of MasterCard. I don't even know what that is. IKVIA, Abbott Laboratories, Nike. So, I mean, you can see, I mean, just is crazy. Schwab's in here. Facebook's in there. I don't even know what this is. So, I mean, but look at that. 9% is represented in Microsoft, man. Isn't that nuts? And it's all good. It's all good. So, if Microsoft does well, it's doing well. Here's IKVIA is doing well. I mean, this guy's earning his money, man. No two ways around that. He's earning his money. The point being is that if you're going to beat the market, you cannot be in a closet index. You can't. I've done a video on this, but no shorts, not doing any leverage. He's just buying some stuff. He's literally saying, I'm going to concentrate on these things, and whatever models he's using is paid off. So good on him. I got no problem with that. Let's go to risk and tax analysis. Do they give us a Sharpe ratio? I'm not sure. I don't pay that much mind to it anymore, but let's see. Average fees, Sharpe ratio. Yeah, so is that 12% more aggressive, more risky than the S&P 500, or is that more? Let's take. I can't remember. Risk estimate calculated using standard deviation, excess return to determine risk reward per unit of risk. The higher the Sharpe ratio, the better the fund's historical risk adjusted performance relative to the standard deviation. So they're making alpha. That's what that is. It's alpha. They're making money relative to the risk they're taking, but that's the standard deviation right there, 20. It doesn't seem that high, actually. Anyway, so the volatility, the investors have varying degrees of risk tolerance that they always seek the maximum rate on return available on their investment. Mean is also commonly referred to as expected return. I don't know how you get that, so I would not use expected return 24. Standard deviation. So in this case, we got 20 as the standard deviation. That doesn't seem extraordinarily high for such a concentrated position. So I mean, on any given year, let's say we expect an average rate of return of 5, just for simplicity. What you do is you take the standard deviation times by 3. That'll give you 60. So on any given year, on the upside, you say we expect an average return of 5. We have a standard deviation of 20, which means if we times it by 3, 99.8% of the time, we should get a return of no higher than 65% or no lower than 55%. Pretty volatile, if that makes sense. Pretty volatile standard deviation. So volatility is your enemy in terms of when the markets are getting crushed, because you're like, oh man. But volatility is also your friend when the markets are going gangbusters. So don't just say volatility is a bad thing. It's not volatility on the upside is a bad thing. It's always volatility on the downside. And someone told me it was a trainer ratio. Is that what it was? Someone measure using effective utilization of market risk. Right. I don't know. There's another. I thought it was a trick. Someone had told me about another benchmark here, what they said in terms of how to look for risk, the downside is a value at risk, but there's a term for it. I forgot what it's called. Anyway, so there you go. So let's take a look. So that's what, if you want to beat the market, you have to be concentrated. There's no other way around that. You can't have a closet index fund. A closet index fund, let me show you. We'll say, I don't know, Fidelity Magellan. I always pick on Magellan. Fidelity Magellan. There we go. It's just because this old has been around forever. Pause real quick. So here's some Fidelity Magellan. Peter Lynch ran it, and Jeff Vinnick. They've had some other managers. I forgot their names anymore, but I don't even know who runs it anymore. It used to be the epitome of a closeted index fund after Lynch left. Because it's so big. It's so big. It has so much money in here. I don't even know, billions of dollars. I don't even know what the NAV is on. There's 14. I'm not even sure what the portfolio, the total market capitalization is, how much cash it's got, but it's so big. It just had to buy stock. Oh yeah, 28 billion, 29 billion. It just couldn't hold on to stocks. It couldn't buy just this top shelf stocks. It had to go down and down and down and buy third, fourth, fifth floor stocks because it has so much money. Turnover rate of 56%. Dag to the nabs. All right, so Assembly Holdings are here. They might have cleaned this out since the last time I looked. It's been a few years, but let's take a look. It might not hold that many stocks. I bet it does with that kind of 58 billion. So let's see the number of holdings. Well, it's only got 71. I'm actually surprised by that. Wow. So Fidelity Magellan's only got 71, and top 10 is 33%. That's interesting. So that's no longer as a closeted index as it used to be. That's for daggone sure. Huh. That's interesting to me. So that's not the closeted index fund. A closeted index fund would have 200 300 shares. You know what I'm saying? But yeah, they charge, instead of being an index fund fees, they charge you 1.5% or something like that. And there's plenty of mutual funds just like off the top of my head, I can't pick up anything. Plenty of mutual funds just like that are closeted index funds. They have many holdings, but they charge a much higher fee than the S&P 500. You'll never beat the market like that. All right, so I own one of this. I own VDIGX. This is my concentrated portfolio, the Vanguard Dividend Growth Fund, VDIGX. I think it only has 440 holdings or something like that. Let's take a gander. Yeah, 48 holdings, got one short, so it went short on one. That's a little bit more holding. Yeah, I guess about right, less than 50. And so I like that. In terms of the overall market, it's got a whole, of the S&P 500. So what you do is you say how many shares does it have relative to the S&P 500. You're looking for something called active share. There's been a couple of studies back in 2011, 12, a couple of guys, one guy at Yale, I think, or two, that got some headway, and then a couple people said, that's not true. But at the end of the day, it makes sense. So active share said if you have 500 stocks, the S&P 500 has 500 stocks, you have 0 active share. It's just that simple. If you have 50 stocks and the S&P 500 has 500 stocks, you got 90% active share. You got 10% of the similarity of the S&P 500. You have a 90% active share. I think they said basically if your active share is over 70% or something like that, you are more likely to outperform the market than the closeted index fund, if that makes sense. So if you're trying to beat the market, you're looking at active share. And I think actually they show that now I think Morningstar has a number on active share. I'm not sure if Schwab does. Let's take a look. Look, and a lot of people say, it's not. There's absolute validity to that, man. It just makes sense. The more concentrated the portfolio, the more likely you are to beat it. It's just that simple. The market, that is. 12B1, I'm looking for active share. Benchmark, I don't see any active share here. So nothing there. Let's go to portfolio. And again, Morningstar has active share. They used to. I don't know if they still do anymore. Because it was all the cat's meow when these two guys from Yale wrote that paper on it. I don't see any active share there. Equity sectors, market cap, value, price of sales. Look at all that. Schwab is just awesome. Fun facts. Did I ever do this? Fun facts and fees? I don't think I did this one. See any active share? No. All right, so I'm not seeing any active shares. So let's do that one. Portfolio risk. Let's go to performance and see if there's anything for active share. But there won't be here. Yeah, probably not. I don't see anything. Rank was category. Okay. Last one, we'll just go to summary. All right, anyway, I don't see it. So what you'd want to do is if you're interested in something that's not a closeted index fund, again, closeted index fund means it has a lot of shares, but it charges a fee. So it basically has a similar take to the index, but they charge a heck of a lot higher fee than the index. If you don't want a closeted index fund, you want to go to Morningstar. Let's just take a look. So I'm not, look at this, 51 billion in the Vanguard fund is crazy. And yet it's only got 47 shares, nuts. I'm not on I don't have the Morningstar Premium anymore, so I'm not sure if I can even see if they'll show it on here on Morningstar for free. Fund analysis. Let's see what we got here. And should you buy this fund? I mean, do what you got to do, man. I like I like Vanguard. I like dividends. Yeah, so I guess they're hiding some of this data. That's too bad. Risk. Let's look at risk. You would think it'd be under here. Alpha, beta, R squared, sharp, standard deviation. Yeah, all right. Do one other thing, portfolio, just and that'll be it. All right. Environmental, social governance, oh no. Historical sustainability score, no. Carbon risk score, no. Oh my goodness. Active share right there. All right, good. Well, wow, that was under what portfolio. All right, cool. So if you're trying to find a fund to beat the market, you'd want to see a higher active share. I think they said 70%. Look, man, I'm not. Don't hold me accountable for that, but I'm just. It's a higher the active share, the more likely you can beat the market. Converse of that is the more likely you get crushed by the market too, if that makes sense. So I could care less about this other stuff. It's fossil fuels. Oh my goodness, fossil fuels. We're all going to die because of fossil fuels. All right. Love your thoughts. We'll see ya.